Now let us talk about the second part of the reading, Indian Financial Sector Structure Trends and Turns by Rakesh Mohan and Partha. We'll first of all talk about the insurance sector. So in the insurance sector, in 1993, there was a committee headed by R.N. Mehlotra. It was set up. And they started the reforms they suggested the reforms in the Indian insurance sector. And they said this, that open up insurance sector to the private players. To private players, one thing. And they can be the domestic players, so they could be foreign players, it doesn't matter. And they also recommended that why don't you establish IRDA? IRDA is Insurance Regulatory Development Authority. And then, based on the recommendation of the committee, IRDA was set up in 1999. And the moment IRDA was set up, there was a monopoly of the public sector earlier in the insurance sector. There was a monopoly of LIC. There was a monopoly of there was general insurance in the insurance sector. Now, with the establishment of IRDA, with the enactment of IRDA Act 1999, this monopoly was broken. Now, other private players could also enter into the insurance sector. And let us just talk about few statistics. They said this, that one, we have 360 million policies. 360 million life insurance policies. So this is one of the biggest in the world in terms of the size, reflecting India's population size. And we have a share of 2.1% in the global insurance business. In the global life insurance business. Right. And this is in 2014. This is in 2014. Then they said that all of these statistics are telling you what is the level of the insurance sector, how the penetration of insurance sector is going up in India. That's what it is. Then you have the rate of insurance penetration in life segment. In life segment. This has increased. I mean, in 2002, and then let's say 2010, right? And then in 2014. So in 2002, it was 2.2%. In 2010, it increased to 4.6%. And in 2014, it again fell to 2.6%. And this is the ratio of premium to GDP. ratio of premium to GDP. And authors say that um, why there is a lower penetration or why the growth rates they have gone down. The reason could be because there is an inflation and it has decreased the disposable income. Hmm. So the overall intention to buy the life insurance that has gone down. That is gone. Hmm. And then they say that there are few problems in the insurance sector. Few problems in the insurance sector. One, it is still dominated by public sector. It is still dominated by public sector. Hmm. Uh, So if you look at the LIC, Life Insurance Corporation, in the total premium, the share of life insurance corporation stands at 73%. So it is still dominated by the public sector. Uh, and in the non-life insurance, the point is the share of public and private. This share is equal. And you are giving this for 2014-15. You're giving this for 2014-15. Definitely, you would need a better expansion of the insurance services. So not only life insurance, health insurance should also go on. So there is a need for much greater expansion of insurance services. So um, not only life insurance but also health insurance. And they say that development of the insurance market is also important because insurance market is providing or is working as an institutional investor for many corporates also, right? So for the development of the corporate market also, you need funds, and the corporate also need funds. So if the life insurance companies, the other general insurance companies, they would be developed, they would be able to mobilize the funds uh, from the premiums which they are getting to these corporates, right? So that is also needed. So please write this. Expansion of insurance funds is also important for the development of capital markets. For the development of capital markets also. Now let us talk about the progress of capital market. So within capital market, we'll be talking about the bond markets, that is a debt market. We'll be talking about equity market, pension funds, and we will also be talking about the mutual fund. So these four parts we'll be talking about in the capital markets. So please write progress in capital markets. And in this, we are talking about the bond or debt market. We are talking about equity market, mutual funds, and pensions. And pensions. Um, and authors, they say this, that the progress in the capital markets is uneven. There is an uneven progress in the different sectors. So let us talk about the capital market first. I mean, what is a capital market? So by capital market, we mean the place, the market in which there are people who are buying securities, who are buying equities, who are taking debt, and there are people who are providing them. There are buyers and sellers of equities. There are buyers and sellers of debt. So that is what capital market is. Hmm. So let me just write one definition for capital market. Please write that. Here, authors are talking about the resource mobilization by commercial sector. Now, when you talk about resource mobilization, what do you mean by that? Resource mobilization is there will be the people who will be needing funds. There will be people who have enough funds and they can lend to those people who want these funds, who can borrow these funds. Now, they there are people who will be interested in selling the short term securities or a long term security. So there are two parts. One is your money market, in which the resource mobilization happens for the shorter duration. Capital market is the one where the resource mobilization is going to happen for the longer duration. So when I say resource mobilization, it means that the resources which people who have funds, those resources will be mobilized to those people who need funds. Who have funds? Those who are savings, those who are saving the funds with them, right? Those who are savers, they have funds, and they are giving it to those people who want funds. Who are demanding funds? Borrowers are demanding funds. So capital market, this selling and borrowing is going to take place where you need funds for more than 1 year. Money market is the one which is you need it for the shorter duration. So resource mobilization is that you are mobilizing resources from people who have funds to those who do not have funds, or who want funds, who demand funds. Now, they are saying that these commercial sector, where are they going for their funds? So these companies, these corporates, when they need funds, where do they go? Do they go to bank? Authors say no, not necessarily. They're not going to banks. In fact, they are going more to the capital market. Uh, so please write this line. That is uh, Indian corporates recourse to non-bank sources. So they said this, that if you look at 2009-10 to the period of 2015-16, so they say this, that 40 to 50% of the funding which they require, they are not going to the banks in order to get that funding. They are going to the non-bank resources, right? And for the non-bank sources, both the domestic as well as domestic sources as well as foreign sources are significant. Right? So, and not only that, even when they are going to the capital market, your Indian capital market, uh, they are getting funds more through the private placement instead of the channel of equity, instead of an IPO. You're getting the point. You're getting the point, or instead through the public offering. So when I say public offering, it is the sale and purchase of securities in the open market. But when I say a private placement, so it means that supposedly if I'm the company and I want funds, so I will be telling some private persons that I will be selling my share of company to you. Please give funds to me. This is private placement. Public offering would be I'm going to open this up to the public, my company's shares, and they can buy it and sell it in the market. You get the point? So what they are saying is Indian market, please write Indian capital market has dependent, has depended, not dependent, depended heavily on private placements. And why do you think they are more dependent on the private placement? Because the costs which are associated with getting funds from the private persons, they are much lesser as compared to listing your company and getting sources, getting it from the public. You get the point? So what is it that we have learned here? One, commercial sector is not necessarily going to the banks in order to get their fundings. They can also get it through the capital market. Within capital market also, they are going more towards the route of private placement instead of going to the equity or the public offering. Right? So equity issues are both. I mean, both are equity. I mean, both are giving share to the people, giving share of your company to the people, both the private placement as well as the public. But in what authors are saying that Indian capital market has depended more on the private placement because the cost of raising funds there are lesser. Now let us talk about the first segment of the capital market, which is the bond or the debt market. Bond or debt market. Well, we can distinguish bond or debt market in terms of uh, the government bonds and the corporate bonds. So the main difference is that government bonds, they have a lesser risk, but at the same time, they have a lesser return also. Corporate bonds, they have higher return, but they also have the higher risk. Naturally, I mean, we will be able to have confidence in the government bonds that government is not going anywhere. Government is going to fulfill its obligation. So we need not worry about it. So government will say when we will be fulfilling our obligation. So why to give higher interest rate? So the thing is there are two types of bond market. One is the government bond market, other is the corporate bond market. And what authors are saying, they are saying that the government bond market has expanded a lot. There is a great expansion in the government bond market, but as far as the corporate debt market is concerned, that is not expanded. That growth is not, I mean, the growth is not in comparison to the government bond market. So let me write few points for you. So very roughly speaking, few things I want to tell about the government bond market. So before liberalization, what used to happen was that in case if the government had a deficit, RBI used to issue bonds and will be giving money to the government, right? Now the thing is that this has led to, this deficit financing has led to a huge inflation, and which is of course bad for the economy. This system has changed in from 1995 onwards. This system has changed, and they have completely phased out this automatic monetization of the deficit. Uh, and this system has changed. So there are two kinds of markets. Even within the government bond market, the way the government bonds are traded is one through the auctions, and the other one through the secondary market. That is, it can be, I mean, sold, your government securities, treasury bills. They could also be sold in the secondary market. That is, in the stock exchanges also. Primary dealers are those who are licensed by the RBI that they can sell and purchase the government security. So they buy government securities from the RBI and they resell it to them. So for RBI, the primary dealers, I think the few examples are Bank of America, Morgan Stanley, Nomura Fixed Income Securities Limited. They, few of them are the primary dealers in the government securities market. Now, what authors are saying is that this market has grown up, it has developed. So there is much development in this market. But if you look at the corporate debt market, you don't see much development. And there are a few reasons for that also. So one, what they are saying is that as far as corporate bonds are concerned, what are generally bought and sold are the bonds of the blue chip companies, bonds of already very established firms. And the market is predominantly, you can say, a private placement market in the corporate bonds. So instead of these companies also, instead of issuing bonds in the open market, they issue bonds to the other companies or through the private placement. One thing is that. So why it is less developed, it has few points. It's right alongside. One. Much of the transactions, much of the transactions are in the bonds of blue chip companies. Second, this is a predominantly private placement market. So even if these corporates, these big corporates want to have funds through bonds, it will be selling it to private placement instead of selling it to the open market. It is predominantly a private placement market. With limited liquidity. Hmm? Other thing. And then they gave reasons for this one, that why exactly it is more like a private placement market. They say this, that was in case if these corporates also, they want to issue bonds, they, instead of issuing bonds to the domestic investors, they do it to the foreign investors. So I mean, for the long term borrowings. So large corporates tend to go abroad for their longer term borrowing requirements, right? Uh, and the other institutional investors could be the pension funds or insurance market. They are already very small in India, according to these large corporates. So uh, they don't have enough options in order to that why should not they get their borrowings from abroad and from India? So that is one of the reasons that they are saying. Uh, on the demand side, with pension and insurance industries, being in their infancy, there are very limited number of institutional investors. There are very limited number of institutional investors. With limited funds. And so these are the few reasons why the your corporate debt market is not developed and the government debt market is growing. Uh, so today we have talked about the capital market and within that the first market, which is your debt market. And we've also talked about the insurance sector. We will talk about the another segments of the capital market in the next recording. Thank you, Beta.